Good morning, good afternoon, good evening, wherever you are in the world, and welcome back to Sip&Talk.
Welcome, everyone.
We're so glad to have you with us. Now, a little while back, we did a big look ahead at the AI investment scene for 2026.
And today, we've gathered up all your questions, and we're here to deliver, well, a pretty big gift. A deep scan from the shoulders of the tech giants themselves.
That's right. We actually had a listener from Taiwan ask, when is the foreign capital coming back? And I swear, I could almost picture you staring at your screen thinking the exact same thing.
Hey, I was not. I was, for your information, watching cat videos.
Huh. Okay. Well, the big investment firms might be on vacation, but we definitely are not. And we've got something way better for you all than cat videos.
Data analysis.
Data analysis. But, and this is the important part, we are data analysis experts, not investment advisors.
Please consult a professional for any financial decisions.
Disclaimer done. Let's get into it.
So today, we're going to take a hard look at the capital expenditures of the AI giants over the last few years. And, more importantly, we're going to identify some of the new opportunities that could actually challenge the current AI leaders in 2026.
Sounds pretty good, right?
Sounds fantastic. I mean, we've gone through 2024, the year of compute power, and then 2025, the year of sovereign AI.
Right.
But 2026 is shaping up to be what we're calling the year of energy AI. And of course, we have to tackle that big question on everyone's mind. Is this all just one giant AI bubble? We're going to answer all of that today.
So let's start with that real turbulence we saw in the market late in 2025. It felt like a really intense recalibration period.
Yeah, it really kicked off around mid-December. It felt like the market just slammed on the brakes.
It did. And it was all because of this fundamental contradiction that investors just couldn't ignore anymore.
You're talking about the spend versus the profit, right? The input versus the output. Precisely. On one hand, you had these staggeringly high corporate AI capital expenditures. The big tech companies were pouring hundreds of billions into chips and data centers.
Billions and billions.
Right. But on the other side, the actual path to making that money back, the monetization strategy, it was still super unclear to a lot of people.
And that disconnect is what sparked the whole bubble debate.
It is. You immediately saw two camps form. The negative view was pure bubble concern. You had analysts like Jim Schneider from Goldman Sachs starting to really question the return on these massive investments.
The whole mood shifted, didn't it? From a mad build-out where you could buy anything with AI in the name.
Yeah, to a very intense profit scrutiny phase. Exactly.
And you have to remember the context here. The whole market was kind of frothy.
It was. The S&P 500's price-to-earnings ratio, the PE ratio, was historically high.
Which basically means investors were paying a huge premium betting on perfect, nonstop growth.
Right. And when valuations are stretched that thin, any piece of bad news, any hint of AI overheating gets magnified because there's just no room for error.
And we saw that happen, right, with Broadcom.
We absolutely did. Broadcom is a key player in the supply chain, a real bellwether. And in mid-December, they gave an outlook that just missed the market's sky-high expectations.
And the stock dropped, what, like 6%?
Nearly 6% in a single day. That doesn't happen unless investors get spooked and think, uh-oh, maybe AI demand has already peaked. It just triggers a rush for the exits.
I get the fear, I do. Mm-hmm. But you can't ignore the other side of the coin, the positive view.
There's definitely a strong case there.
For instance, TSMC's revenue growth in 2025 was still incredibly strong. Mm-hmm. Year-over-year growth was over 30%. That doesn't scream bubble to me.
No, that suggests real fundamental demand. That's very different from the dot-com era where you had companies with no revenue at all.
And what's really compelling for the optimists is that the order books for guys like NVIDIA and TSMC, they're full. Yeah. Deep into 2026.
The demand for the physical hardware, the foundation of all of this, it hasn't gone away. So the optimistic take is that this was just a, quote, healthy correction.
A reality check.
Exactly.
Okay.
The market just got a little too far ahead of itself. It was tightening the leash, not abandoning the race entirely.
Okay, so that contradiction was the spark. But there were some other big factors that were like pouring gasoline on the fire.
Oh, absolutely. The macro environment amplified this whole sell-off. It wasn't just happening in a vacuum.
First up was the Fed, right? The Federal Reserve.
Yep. They cut rates in December 2025 down to the 3.5 to 3.75% range. And on the surface, that sounds good.
Right. A rate cut should have caused a relief rally.
You'd think so.
Yeah.
But they paired that cut with their economic projections, the infamous dot plot. And that plot signaled they might only make one more cut in all of 2026.
Oh. So they gave with one hand and took away with the other. The market was betting on a whole series of cuts.
Exactly. They dashed those expectations. And it got dubbed the hawkish rate cut. Any relief just evaporated instantly.
And then there was the international piece. Japan.
The Bank of Japan. This was a huge trigger. Policy changes there forced a massive global carry trade unwinding.
Okay, can you break down the carry trade for us, for maybe our listeners who aren't economists?
Of course. So for years, Japan had ultra-low, near-zero interest rates. The carry trade is a strategy where big funds borrow money very, very cheaply in Japan.
In yen.
In yen, right? And then they take that borrowed money and invest it in higher yield, higher risk assets all over the world. U.S. stocks, emerging markets, you name it.
It's like financial arbitrage on a global scale.
It is. But when the Bank of Japan starts hinting that they're going to raise rates, that cheap borrowing suddenly gets risky.
And you have to pay back the loan.
You have to pay it back. So those funds are forced to sell their global assets quickly to close out those positions before the rates go up.
And one of the places they sold heavily was
Taiwan. Foreign institutional investors sold up to 59.5 billion TWD worth of Taiwanese stocks in a single day. It was a massive withdrawal.
And the important thing to understand is that it wasn't because they suddenly lost faith in TSMC.
Not at all. It was driven by a global interest rate shift, but it massively amplified the volatility there.
And then, just to top it all off, you have the usual year-end stuff.
The classic year-end effect. You have institutional funds doing what's called window dressing.
Which is basically selling their winners to lock in profits for their annual reports.
Yeah. Show their clients how smart they were. So you combine that with high valuations, rate uncertainty, and the carry trade unwinding. It's a perfect storm. And it hits the biggest, most liquid stocks the hardest, like TSMC.
So that brings us back to our listeners' question. When do the funds come back?
Okay, so the timeline here is actually pretty predictable. Foreign funds typically go into, let's call it vacation mode. Around December 20th, trading volume just dries up.
It can drop by half, sometimes more. It's impossible to see any real direction in the market.
Right. The real significant capital allocation decisions, those are saved for the new year.
So based on what we've seen in the past,
based on historical patterns, we expect the big money to really start flowing back after January 5th, 2026. That's when traders are back, investment committees are meeting, and new budgets are deployed.
The opening bell effect for the new year.
That's it. And if the first week outlooks from NVIDIA, from Microsoft are positive, you can bet the capital will flow right back into the leaders, including TSMC. The money is just waiting on the sidelines.
So my takeaway from all this is that it's really not a bubble bursting.
I agree. It feels much more like AI's adolescent growing pains.
Yeah, that's a good way to put it. This kind of volatility is almost necessary, assuming AI really does deliver that projected 1.6% boost to global GDP.
It's a speed bump, not a cliff.
And it serves a really crucial purpose, right? It separates the real players from the fakers.
Yes. It forces the market to distinguish between companies with real proprietary tech and a clear path to profit.
The ones that just slap .ai onto their company name.
Exactly. If you can't show how you're converting all this hype into actual profit in 2026, the market is going to execute a very rapid valuation kill.
All right, let's talk about the fuel for this whole revolution, the money. We are moving into the year of scale-up.
And the sheer scale of the spending by these tech giants is so vast, it's actually changing global economic patterns.
It really is. I mean, when we add up the total capital expenditure, the CapEx, for the main hyperscalers, we're talking Microsoft, Amazon, Google, Meta, Oracle.
The number is just mind-boggling. The total spend for these major cloud providers is expected to exceed $520 billion in 2026.
$520 billion. Let's put that in context for everyone. That is roughly 1.6% of the entire U.S. nominal GDP.
They're not just participating in the economy. In many ways, they are the economy. They're the single biggest driver of infrastructure investment on the planet right now.
And when you look at who's growing the fastest, you really see the strategy. I mean, look at Meta.
Meta's a great example. They're projected to jump from around $72 billion to almost $97 billion in CapEx in 2026. That's a 35% year-over-year increase.
So that's all going toward what? Training Llama 5?
Llama 5, building out their metaverse infrastructure.
Yeah.
They're being incredibly aggressive. Oracle is another one, projected at a 34% increase. They're making a huge bet to become this sort of neutral AI cloud for everyone else.
The Switzerland of AI infrastructure.
Kind of, yeah. And it helps to look at this spending spree in 3 distinct phases.
Okay, lay it out for us.
Phase 1 was 2024. We called it the grab year.
That was the scramble for NVIDIA's H100s. Just get the chips, whatever the cost.
Get the chips. If you didn't have the chips, you couldn't train your models. Simple as that.
Then came phase 2.
2025, the infrastructure year. This is where spending growth really peaked, over 50% year over year in some cases. The focus shifted from just chips to everything around them.
The data centers themselves, the power, the cooling, the physical buildings.
Right. Which leads us to where we are now, 2026, the bottleneck and verification year.
The year of reckoning.
In a way, yes. The spending growth rate is slowing, down to around 30%, not because they don't want to spend more, but because they're hitting physical limits.
The wall we were talking about earlier.
The wall. So the focus has to shift. It goes from training, which is CapEx intensive, to inference the cost of actually running these models for millions of users. And most importantly, proving that this $500 billion investment actually generates a return.
And you can see these warning signs flashing already.
Oh, absolutely. The warning signs are coming directly from the trenches. Look at the delays at a company like Oracle.
They're a key infrastructure provider, and they've had significant delays building out new facilities.
Globally. And this is a huge signal. It shows that even having billions of dollars in CapEx can't solve the slow, multi-year reality of getting grid capacity, of sourcing massive electrical transformers.
You can't just Amazon Prime a nuclear power plant.
You cannot. And that physical delay has a cascade effect. If your data center isn't ready, you can't plug in the chips you ordered from NVIDIA.
So the chips just sit in a warehouse, generating zero value.
Exactly. It forces everyone down the supply chain to adjust their expectations. The efficiency of turning capital into actual computing is dropping.
Which brings us to the big showdown at the top. The hyperscaler battle. Microsoft versus Google.
And this fight is no longer about who has the flashiest demo. It's about who has the best cost control.
Let's start with Microsoft. They're facing what some analysts are calling a capital expenditure trap.
They are. Their CapEx is projected to break $85 billion for fiscal year 26. The market is getting really nervous about how much that's draining their free cash flow.
They need a massive, obvious revenue win to justify that kind of spend.
And the early signs from their big bet Copilot are a little shaky. The Copilot reality check.
What are we hearing?
Reports suggest that renewal rates for Microsoft 365 Copilot are lower than expected. Companies are looking at that $360 per employee annual fee and asking, what's the tangible ROI?
If you can't measure the productivity boost, that's an easy line item for the finance department to cut.
It is. And on top of that, Microsoft is hitting a kind of valuation ceiling. Their market cap has been bumping up against $4 trillion.
$4 trillion.
To keep growing at the rate Wall Street demands from that massive base, it's just incredibly difficult. It's the law of large numbers.
Meanwhile, over at Google, it feels like a comeback story.
It does. They've gone from that internal code red panic a couple of years ago.
When they thought ChatGPT was going to eat search for lunch.
Right, to a phase now of sort of strategically harvesting the rewards of their long-term bets.
Gemini 3 was a big part of that, wasn't it?
Huge. It basically calmed the fears about search, and their AI overview feature is actually driving higher ad prices. They successfully defended their home turf.
But their real secret weapon, the thing that gives them a long-term advantage, is the chip.
The TPU. Their proprietary tensor processing unit. This is the key, because they design their own chips specifically for their own AI models.
They control the whole stack.
They control the whole stack. And that integration allows them to cut their AI training costs by an estimated 30 to 40% compared to their rivals who have to buy off-the-shelf NVIDIA GPUs.
So they're running the race on their own, custom-brewed, cheaper fuel.
That is the perfect analogy. So if you're summarizing the rivalry for 2026, Microsoft won the name recognition early, but they're losing on cost.
And Google, by winning the cost battle, has secured its territory for the long haul. The race is now about who can run the furthest on the cheapest fuel.
And that leads us directly into the biggest bottleneck of all. The reason we're calling 2026 the year of energy AI.
Because the main constraint is no longer the supply of GPUs.
No. The constraint is now the hard physical limit of electricity and energy.
This is where the money and the ambition run headfirst into physics.
And physics always wins. We are seeing data centers demand power at a rate that is just. It's almost hard to believe.
What are the numbers?
By 2026, we project that at least 5 separate data centers in the U.S. will each exceed 1 gigawatt of peak power usage.
1 gigawatt. That's the output of a large nuclear power plant.
For a single corporate facility. And globally, it's expected to double by 2026 to around 96 gigawatts. A huge growing chunk of that capex we talked about is now just going to solving this power problem.
So how are they solving it? What's the plan?
It's a massive infrastructure revolution. We're seeing a 3-pronged solution to this power thirst emerge.
Okay, prong number 1.
The most radical one. Nuclear and behind-the-meter power.
What does behind the meter mean?
It means they're bypassing the traditional power grid. Waiting for a utility company to approve a new connection can take years, and they don't have years.
So they're building their own power plants.
Or buying power directly from a dedicated source. We've seen Microsoft make a deal to use power from the reopened 3 Mile Island plant. Amazon bought a data center park that's literally right next to a nuclear facility.
And there's a lot of talk about SMRs, small modular reactors.
SMRs are the key. Unlike giant traditional nuclear plants that take a decade to build, SMRs are smaller, they can be factory built, and they're much faster to permit and deploy.
So they can put one right next to the data center as powering.
That's the dream, and 2026 is the critical year for getting those sites permitted and the contracts signed.
Okay, prong 2.
Grid modernization. You can't just plug these gigawatt-level facilities into an electrical grid that was built in the 1970s.
It would just collapse.
It would. So they're having to invest in high-resilient systems, things like high-voltage direct current lines, digital grid management, because for an AI training run that costs millions of dollars, you cannot afford a single power flicker.
Zero tolerance for failure. And the third prong.
The third prong is the efficiency savior, liquid cooling.
So getting away from just using giant fans.
Way beyond that. Traditional air cooling is becoming obsolete. The sheer heat density from the computer racks in 2026, which can be over 200 kilowatts per cabinet, is just too much for air to handle.
And liquid is just much more efficient at carrying heat away.
Far more efficient. Liquid cooling can reduce the energy used just for cooling by 30 to 40%. It's all about a metric called PUE, or power usage effectiveness.
And you want that number to be low.
As low as possible. Liquid cooling helps keep the PUE below 1.1, which means almost all the electricity is going to computation, not just running the air conditioner.
When you look at all these shifts, you start to see who the real invisible winners are.
The shovel and water sellers, exactly. While everyone's focused on the next NVIDIA chip, the smart money is moving into energy infrastructure.
These companies that used to be seen as boring, defensive utility stocks
are now being redefined as hyper-growth tech enablers. You're looking at companies that provide that stable 247 baseload power, like Constellation Energy.
And the ones that make the actual hardware, right? The transformers and switchgear?
Yes. Companies like GE Vernova and Eaton, their order backlogs are stretching out to 2027. They literally cannot make this stuff fast enough.
And of course, the cooling companies like Vertiv.
Vertiv is in the perfect spot. The move from air to liquid cooling is not optional, it's a requirement. So their growth is practically guaranteed.
But this brings up a huge contradiction, doesn't it? The carbon neutrality paradox.
A very inconvenient truth. All the big tech giants have made these huge commitments to be net zero, usually by 2030.
But their actual power consumption, their actual carbon footprint, is going up, not down.
It is. Their need for compute is directly clashing with their climate goals. Renewables like wind and solar are great, but they're intermittent.
And AI training needs stable, always on baseload power.
Which means, despite their public pledges, they are becoming more and more reliant on stable, low-carbon nuclear and, in some cases, high-efficiency natural gas. The compute goal is winning out.
So let's talk about the economic fallout from all this. We're entering a phase of what you call the cruel pruning process.
Or creative destruction. This is the point where AI stops being a rising tide that lifts all boats.
And starts becoming a ruthless efficiency filter.
Exactly. It's starting to eliminate companies whose business model is based on, well, inefficiency or information gaps. Think traditional outsourcing, human content farms.
Or any software company that's just a thin wrapper around a generic language model.
Right. The market is performing a swift valuation kill on them. If your gross margins are collapsing because you're spending all your money buying compute from Amazon, you're not an AI company, you're a customer.
And this creates a huge polarization effect.
It does. All the wealth and all the pricing power funnels up to the very few companies that own the core infrastructure, the unique data, or the specialized chips. The K-shaped recovery just gets steeper.
So for the U.S. economy as a whole, it sounds like it's going to be strong but painful.
That's a great way to describe it. Let's look at the golden side of that coin first.
The productivity boom.
A massive one. AI is predicted to boost U.S. labor productivity by 1.5% every year for a decade. That's huge. It structurally pushes down on inflation, especially in the service sector.
Because AI agents can start doing things like legal document review or basic diagnostics for a fraction of the cost.
The cost of white-collar work just plummets. That's the golden side.
But then there's the dark side.
There is. We saw mass layoffs in the tech sector, over 120,000 in late 2025 alone. If that trend of automation continues, we risk damaging the strongest pillar of the U.S. economy.
Which is our own internal consumption. 70% of the economy.
And this leads to the consumption-demand fracture. It's the critical question for the next decade. If 80% of the economic output is created by 20% of the companies.
And unemployment for everyone else ticks up to 6 or 7%.
Who is left to buy all the stuff that this super efficient AI economy is producing?
It's the ultimate paradox. The drive for perfect productivity might kill the very market you need to sell to.
And that uncertainty is what's driving the value chain migration we're seeing right now.
Okay, let's break that down. First, the hardware, the servers.
The growth rate there slows way down, from over 100% year over year to maybe 20%. The value shifts from just selling boxes to selling highly integrated, specialized systems. Think liquid-cooled racks.
Next, energy and power.
That becomes the main bottleneck, so you see a PE expansion in those stocks. The boring utility companies become the hot new growth story.
And finally, software, the invisible hand.
The killer apps aren't being sold by startups in an app store. They're being absorbed directly into the giant platforms.
Like Apple Intelligence in iOS or Gemini inside Google Workspace?
Exactly. They become infrastructure features, not standalone products. And that suffocates the startup ecosystem.
So when we look ahead to 2026, the winners aren't just the ones with the best tech.
No. The winner is the one who transforms AI into low-cost productivity. Those are the new pricing power leaders.
And who are they?
Group 1. Energy and cooling. The companies solving the physical bottlenecks. The SMR developers, Vertiv, the heavy electrical equipment makers, they control the pace of the race.
Group 2.
ASIC dominance. So, customized chips. As operational costs soar, companies are desperate for efficiency. So you'll see growth in custom chip makers like Broadcom and Marvell, and in companies using their own internal chips like Google, outpace the general-purpose GPU market.
And the third group?
Agentic AI. This is the big leap from chatbots to true autonomous AI agents that can handle end-to-end business solutions. Think digital workers.
So companies like ServiceNow or Salesforce?
Exactly. The ones that can offer true autonomy. They're not just selling a tool. They're fundamentally redefining the price of labor itself.
It's so clear that 2026 is the year of verification. The market is screaming, show me the money. Does this $500 billion spending spree actually pay for itself?
Which brings us to your final provocative thought for our listeners.
Right, so here it is. If all the truly successful, high-value AI software gets absorbed and integrated by the hyperscalers, by Google, Apple, and Microsoft, and the path for a startup to have an IPO or independent success gets choked off, what happens to the innovation and the risk-taking of the entire startup ecosystem in 2026 and beyond? Does the centralization of value inherently kill the spirit of Silicon Valley?
That is a fundamental structural challenge to the way we've thought about tech growth for decades. And to recap our theme today, 2026 is the year we start talking about AI in the abstract and start dealing with the hard reality of the physical constraint era.
Absolutely. The competition is no longer about who can buy the most chips. It's about who can, and I love this phrase, generate the most tokens with the least amount of electricity. It's all about efficiency.
And as always, a reminder that we are providing data analysis, not investment advice. Please consult a qualified professional for your financial decisions.
Now, for all of you, our Sip&Talkers, we want you to challenge us. Seriously, send us your counter-arguments, your own data. We want to have a logical exchange of views.
That's the whole point of the show. We're not trying to prove that we're right. We're trying to make the entire discussion more well-rounded and multifaceted. Please, try to seek out information from multiple authoritative sources.
Don't get stuck in a single narrative.
Yeah.
You have to actively try to break out of your information cocoon. That is how you develop the independent, critical thinking you need to navigate all of this.
We really look forward to hearing from you. And make sure you subscribe to Sip and Talk wherever you're listening.
Oh, and check out our old friend Mickey's YouTube channel, Mickytolife. He just dropped his 9th travel vlog. He went to the Jameson Distillery in Ireland. Go see if he had a good time.
We'll see you all next time.